Today's video is going to be insane. Imagine waking up to headlines talking about bond market meltdown. And you log into your brokerages and you see yields spiking, bond prices plunging, and your safest assets bleeding. Jamie Dimon says regulators will panic. Dalio warns of a death spiral. And we've already issued $6.6 trillion in new bonds this year between January and July. And that's matching the total number that collapsed in 2008. If you're invested in bonds or assets tied to credit markets or in any other markets, because this will affect everyone, you need to watch this video. Welcome back to StockScope Live. I'm your host, Ali, and today we're unpacking the world's looming bond market meltdown, an event mathematically 100 times worse than 2008. From Jamie Dimon's alarm to Ray Dalio's death spiral, this is a crisis no investor can afford to ignore. Over the past few weeks, I've been analyzing the data, and it almost keeps me up at night. What I discovered connects the recent TriColor Auto bankruptcy, massive government borrowing, and the derivative market leverage into a perfect storm that makes 2008 look like a warm-up act. But before we dive in, make sure you hit the notification bell. This type of analysis could literally save your portfolio, and I want to make sure that you don't miss any updates as this situation develops. Also, if you find value in today's content, a like really helps the algorithm share this information with other investors who need to see it. Let's start with the hard data, because this isn't about fear-mongering, it's about math. And as you can see on the screen, we've collected this data from a report from PCW, and we're unable to show the actual report on this video due to it being behind a paywall. So if we look at these values and the types of bonds or securities that have been issued in just 7 months, we can see a total of 6.625 trillion in issuances. That's between treasuries, 2.8, corporate bonds, 1.3, mortgage-backed securities at 1, federal agencies, 846 billion, municipal bonds at 338 billion, and asset-backed securities at 269 billion. Now, for those beginners who don't know what any of this means, I'm going to provide these definitions in the description below. Now, why is this number so significant? Well, because the entire mortgage-backed security market that collapsed in 2008 and triggered the global financial crisis was approximately 6.6 trillion. That wasn't 6.6 trillion in 1 year. It was accumulated over time to get to 6.6 trillion. And we've essentially created that same amount of potentially problematic debt in less than a year that it took years to build up before 2008. And here's where it gets worse. The derivative market, these are financial instruments that derive their value from underlying assets like bonds. And it currently sits at a mind-blowing, staggering number of approximately 700 trillion US dollar in notional value. That's roughly the same size as it was in 2008. But now it's supporting this massive new wave of debt issuance. Think of derivatives as leverage. They amplify both the gains and the losses. And so when Jamie Dimon says you're going to see a crack in the bond market, he's not just talking about bonds. He's talking about the entire interconnected system that could amplify any bond market problems by hundreds of times. We're going to go ahead and play 2 clips, one from Jamie Dimon and one from Ray Dalio, so you can hear what they have to say.
And you are going to see a crack in the bond market, okay? It is going to happen. And I tell this to my regulators, some of who are in this room, I'm telling you it's going to happen, and you're going to panic. I'm not going to panic. We'll be fine. We'll probably make more money, and then some of my friends will tell me that we like crises because it's good for J.P. Morgan Chase. Not really. I tell people when Credit Suisse went bankrupt at the First Republic, it was terrible for the banking industry. I think we can make everything better, including that, by just changing and modifying certain rules and regulations, letting market makers intermediate more in the market. But to give you a number, like just J.P. Morgan alone buys and sells $3 trillion a day. And we move $10 trillion a day of money. And we're probably a tenth. So the money moving around the world is $100 trillion a day. The money moving around in the investments, this is stocks, bonds, corporate governments, derivatives, credit, you name it, FX, sovereign debt around the world, 30 trillion. The people who set those long-term rates are those people, including you in the room. It's not the Federal Reserve. They can try to manipulate the long-term rate. They can do what's it called? They do the twist or whatever. It doesn't work for that long. So if you look at economic history, bad things happen. When those tectonic plates shift, it's very hard to see in real time. It is shifting, and this is one of them. I just don't know if it's going to be a crisis in 6 months or 6 years. And I'm hoping that we change both the trajectory of the debt and the ability of market makers to make markets.
When you run a large deficit, you have to sell debt to do that. And the quantity of debt sold has to come up against how many buyers are there. And when I calculate it, the quantity of debt sold to be sold is much greater than there is the buying power, the inclination to buy. So that's the second thing. The debt service payments having that problem, the problem in terms of the supply demand. And then you get into a dynamic when it gets bad in that debt service that you have to you can have selling of existing debt. And that's when you have real problems. Now, in the private markets, credit markets, we just talk about a death spiral. And a death spiral is that part of the cycle when the debtor needs to borrow money in order to pay debt service, and it accelerates, and then everybody sees that and they don't want to hold the debt. That's where we're approaching.
All right. Well, let's take a look at this article, and then we're going to talk about TriColor. So what is happening in the bond market? As you can see, the global bond market is experiencing a seismic shift that many experts believe signals the end of a 4-decade trend, because bond yields have followed a consistent downward trajectory until now. And the Federal Reserve economic data is talking about the 10-year Treasury yields climbed drastically between around 2021 till mid-2025. And this representing a decisive break of that trend that was 40 years in the making. What makes the current situation particularly concerning? And this article talks about it's not just about the rise in yields, but the breakdown of historic patterns that investors have relied upon for decades. U.S. government bonds, long considered the world's ultimate safe haven, are showing signs of structural weakness. Let's look at the signals of structural failure versus temporary decline, according to this article. First, we have the persistent yield curve inversions. The 3-month and the 10-year Treasury yield curve has remained inverted for 26 consecutive months as of July 2025, exceeding the previous record set during the 1978 to the 1980 timeline. Number 2, the massive refinancing needs, and this one is crazy. There is $8.9 trillion of U.S. government debt that will mature between 2025 and 2027, requiring refinancing at the new rates, which are significantly higher than when they were issued. Number 2, which is also critical, is the technical breakdown. Bond prices have fallen below critical long-term support levels. And then we have the foreign buyer strike. Despite the higher yields, countries like Canada, China, and others are selling U.S. bonds. They're not holding on to them. This combination, according to this article, this combination of factors suggests the bond market may be approaching a point of no return, where traditional policy responses become increasingly ineffective at stabilizing the prices. Now let's talk about TriColor, because TriColor is kind of a crazy story. When you think about TriColor, you're thinking about an agency or a lender that has rating agencies making sure that they're doing the things the right way because they gave them a AA rating. It was hailed as a model for social impact lending. Okay? Now you might be thinking, surely the ratings agency learned from their lessons in 2008, right? Wrong. Let me tell you about TriColor because this case study shows exactly how broken the financial oversight system in the US still is. TriColor was a subprime auto lender that gave loans to people without social security numbers, without credit scores, and in some cases without driver's licenses. They allowed zero down payments and had incredibly loose lending standards. Yet their bonds were rated at a double A by rating agencies just 3 months before the company collapsed into bankruptcy. Here's where it gets really crazy. Investigators so far found that approximately 29,000 loans, which represents 40% of the active portfolio, were fraudulently pledged to multiple creditors. This is called double pledging, and it's the exact type of fraud that amplified the 2008 crisis. Now, major banks like Fifth Third lost $200 million. JP Morgan had significant exposure and about $2 billion in asset-backed securities that had to be suspended. The bonds went from a double A rated to almost worthless in months. And if rating agencies can't detect this level of obvious fraud, what does that tell us about the other $269 billion in asset-backed securities that we showed in the Excel sheet that was issued earlier this year? Or in the $1.3 trillion in corporate bonds? The same agencies that gave Lehman Brothers an A rating just months before it collapsed in 2008 are still operating with the same broken methodologies. There's a guy named Mitch Smith from Mockingbird Properties. He released a document that's like 84 pages long, but I'm going to cover some of his key findings. He says, and I quote, "Channels of finance are stuffed with fraud via created credit and unchecked money printing, enabled by no oversight, leading to overvaluation of corporate and personal assets and correlated taxation inflation by fraud." He also talks about, and I quote, 37% of households, which is roughly 42 million, face bankruptcy or homelessness. Economic fallout will far exceed the 2007 crash. Rating agencies granted AA to subprime auto lenders with no credit borrowers by mistake, proving due diligence failures. And median household income cannot cover school district bond interest payments, increasing default probability daily. And he reminds us that the Lehman Brothers bonds were rated A in June of 2008, but defaulted 3 months later, demonstrating rating agency uselessness. Ray Dalio has been particularly vocal about what he calls a death spiral, and the government data supports his concerns. I'm going to play a second clip where he talks about some of this information.
And then the third is the great world order, how countries deal with each other. When there's a rising power challenging an existing power, and now we are going from multilateralism, which is largely an American world order type of thing, to a unilateral world order in which there's great conflict. And the other two factors all through history have been acts of nature, droughts, floods, and pandemics. And number four is technology changing. And how they are coming together are the main forces behind this. For example, there can't be imbalances anymore in that environment.
Of the $6.6 trillion in new debt this year, $2.8 trillion, nearly 43%, was treasury bonds. That means the US government needed to borrow almost $3 trillion in just 7 months. At this pace, annual government borrowing could exceed $5 trillion. Here's the math that keeps people like Dalio up at night. The government is now spending 40% more than it takes in through taxes. So debt service payments are approaching $1 trillion annually. When you need to borrow money just to pay the interest on money you've already borrowed, you're in what economists call debt spiral. But it gets worse for us investors. When the governments flood the market with new bonds, they crowd out corporate borrowers and create what's called supply-demand imbalance. there simply aren't enough buyers for all these bonds at the current interest rates. What happens when there aren't enough buyers? Either the interest rates have to rise dramatically to attract new buyers, which crashes existing bond values, or central banks have to step in and print money to buy the bond themselves. This creates inflation. Either way, your savings and investments get absolutely crushed. I want to take a moment to give you my opinion on rating agencies and auditors. And in my opinion, rating agencies have aided criminal conspiracies. Their luck-based successes mask lack of true diligence. Investors must insist on proper due diligence rather than rely on these agencies, because they failed us over and over and over again. Auditors, mandated by law, fail to audit beyond small segments, which makes them miss the full picture. School district superintendents and CFOs committing accounting fraud must be held accountable to prevent crisis larger than 2008. If this analysis was helpful, please hit the like button and subscribe to the channel. I'll be monitoring these bond market developments closely, and I will provide updates as new data becomes available. Drop a comment below. Are you adjusting your portfolio based on these bond market concerns? And what's your biggest question about protecting your investment in this environment? Remember, this video is for educational purposes only. Every investor's situation is different, so please consult with a qualified professional before making any major portfolio changes. Just as a point, the data we discussed today comes from official sources like the Bank for International Settlements, the Office of the Comptroller of Currency, and public SEC filings. Until next time, stay safe, stay diversified, and I'll catch you in the next video.